Hi everyone, Team 8 here. So today we're going to expand on international capital budgeting, review the BlackBerry Europe case, and then move on and look at some problems. So after the net present value equation is restated, accounting for both operational after-tax cash flow and tax benefits from depreciation, now, using Modigliani and Miller's approach for an unlevered firm, we can adjust the present value and restate the NPV into APV model. The reason it's called adjusted present value model is because every cash flow in the model is discounted at the rate which is consistent with the risk associated with the cash flow. So here in the formula, you can see that both after-tax operational cash flow of the firm and the total terminal value of the enterprise is discounted at the rate KU, which is essentially the cost of equity for all equity-financed firm, because it doesn't matter whether a firm is levered or unlevered, and it will receive the cash flows from the capital projects anyways. While the tax savings due to both depreciation and interest expenses are discounted at before tax borrowing rate I, and the reason behind that is because those returns are less risky and they are not likely to change a lot throughout the entire economic life of this project. However, when we look at the situation in global perspective, sometimes we can face the situation when positive APVs from subsidiary projects result in negative APVs for parent firm perspective. That can happen because either certain cash flows might be blocked by the host country or the host country impose extra taxes on the foreign exchange remittance, or if the home country just have an overall higher marginal tax rate. That is why when the ownership of multinational is a domestic one, we must recognize that the foreign cash flows will be converted to home country currency so we can see a direct benefit to the shareholders. That is why we adjust the APV model so now it accounts for the spot rate from host country currency to home country currency at the relevant time period, as well as we account for a couple more elements that you can see in the formula above, which is namely RF. RF is the value of accumulated restricted funds in the host country from the existing operations, and those funds become freed after the project is accepted. Sometimes the host company can just impose certain limits on the exchange remittance, and that means that the funds are just locked in the country. But after the company accepts a project, you can use those funds and allocate them for your capital project. The last two elements of the formula are basically the present value in parent firm currency of the concessionary loan. The concessionary loan is the subsidiary loan that host countries sometimes offer for firms in order to attract more funding and more foreign investments in the country. Basically, what happens is that the government provides borrowing for the company at the rate that is below the market borrowing rate. And by discounting the present value of those loan payments at the borrowing rate of the home country, which is natural for the banks, we can receive some benefits, which essentially will be a subsidy of the host country for our capital expenditures on their land. Okay, so now let's look at some real life examples with BlackBerry Europe case. As many of you probably already know, BlackBerry is, or I should say was, a huge cell phone manufacturer in Canada, And so in this case, BlackBerry is considering establishing a manufacturing facility in Europe, in Germany, for its products. So in this case, it won't have to export any more of these goods in Europe. BlackBerry believes that by accepting this project, not only it will be able to expand its current customer base in Europe, but also it will add significantly into lowering of production costs. If the project gets accepted, German government promised to provide a financing at a below market rate of 6%, and the concessionary loan will be received at the rate 3% lower than the rate BlackBerry would typically obtain it with. So now let's calculate. The span of the project is 8 years, because this is the time the government agreed to fully depreciate the plants, as well as this is the period of time the government is providing the concessionary loan for the BlackBerry. So now, to simplify our findings, we use the purchasing power parity formula to calculate the appropriate spot rate at every period of time for the project in the column 2 here. And then, when we have that, we can find incremental dollar operating cash flows by simply subtracting the value of lost sales from the value of European sales. Now, in order to calculate European sales, we simply multiply the expected amount of sales by the per unit contribution of the product, and then we discount it at appropriate European inflation rate. When we look for lost sales value, and lost sales are essentially those export sales that were lost to the parent firm in Canada when the manufacturing shifted to Europe, we find this value by multiplying the forecasted amount of lost sales by its per unit contribution in Canada, and then we multiply it by Canadian inflation factor at relevant time period, discounting it properly. We use it because we look at the Canadian market when we talk about lost sales. It's always the parents firm perspective we account for. So now, when we have all the incremental dollar cash flows for each year, we simply multiply it by 1 minus tax rate in Germany, and then when we discount it at an appropriate cost of levered equity rate, we find out that the present value of all after-tax net operating cash flows equals to $5,732,060.70. Let's look what's going on next. And now we have to find out all the accumulated cash flows coming from tax savings due to depreciation of the plant. And we do that by first looking at the depreciation schedule of the project. So here, because the company uses straight line depreciation throughout the entire lifespan of the project, we can see that the depreciation expense for each project will equal to 625,000 euros per year. And now, having the appropriate spot rate calculated already, we simply convert euros to dollars, multiply them by appropriate German tax rate, and then discount them using the interest borrowing rate from a home country. We always use the parents firm country in order to depreciate such cash flows because it shows the appropriate risk associated with this cash flow. And now, in order to check if there are any subsidies coming from the host country government when it provides a concessionary loan, we first have to calculate the present value of concessionary loan payments, which would be the equivalent of the loan available in Canadian dollars at an appropriate Canadian rate in Canada. Basically, the calculation for this one is pretty straightforward as we use principal payments, which are 400,000 euros for each year, and we calculate the interest expense for each year as well. We can notice how it declines as the outstanding loan payment declines, which is pretty logical and obvious. And then, after we calculated those, we can simply use our previously calculated spot rate for every year and multiply it by the amount of principal payment and the interest expense for each year. Then we simply discount it at an appropriate borrowing rate in the home country, so at the Canadian borrowing rate, which is 8%, as in the previous slide. And at the end, we're able to find out this entire sum of all the discounted cash flows coming from the loan payments, and it equals to $4.5 million in this case. Basically, what it means is that if the company would borrow the money from the Canadian bank, that would be the present value of this loan.
When calculating the present value of the benefit from the concessionary loan, we'll have to use some of the details and the answer we got from Exhibit 17.4. And the formula is given below, whereby we already know that the concessionary loan, which is 3.2 million in euros, in the plant is to be built in Yale. So this is the amount of money the BlackBerry will be eligible to borrow. And we already knew that they can get the 6% BlackBerry cost of borrowing at the concessionary rate. That's why we're using the 1.6. So after doing our calculation with that, we have to minus the answer we got from Exhibit 17.4, which shows the difference between the dollar value of concessionary loan and the equivalent dollar loan value. So after getting our answer will be 535,346, which the difference of this represents the present value of the benefit of below market rate financing the concessionary loan present. When we are calculating the present value of the interest tax shield, we will derive our interest payment from Exhibit 17.4, and we shall use the concessionary loan interest rate of 6%, which was already given in our mini case. And we already know the concessionary loan of 3.2 M in euros represents the 64% of the project cost, which we were told the project will cost at around 5 million euros. So the borrowing capacity created by the project, which will be 4 million, it implies the optimal debt ratio, whereby you can see below where we have the 4 million divided by 8 million of the dollar cost of the project, whereby you'll get the optimal debt ratio of 0.5. And you can see our percentage borrowing, which is the 3.2 M in euros divided by the 5 million for the project cost, whereby you'll get the concessionary loan represents this much percentage value of the project cost, whereby you get the 0.54%. And by calculating this using the formulas given above, whereby you'll get, you use the A, B, C, and the rest. Once you add all this up, you'll be able to get the present value of the interest tax shield. And we already know that 78%, which is 50 out of 64, of the interest payment on concessionary loan should be used to calculate the interest tax shield. which is discounted at the BlackBerry borrowing rate of 8%. So after doing all our calculations, we will get 287,137. So that's how we do this calculation. Calculating our annual present value, we understand this includes the many terms for the cash flows frequently encountered in analyzing the foreign capital expenditure. And that's why we will have to use the calculations we've done from previous exhibits. So for the annual present value, we'll have to know the present value of the net operating cash flow, which we calculated in exhibit 17.2, whereby we got our answers 5,732,061. Then we will add it to the present value of depreciation tax shield, whereby we got our answer from exhibit 17.3, which is 1,932,959. We add this to the present value of the benefit of the concessionary loan, whereby we got it from exhibit 17.5, and we got the 535,346. We will add it to the present value of the interest tax shield, which we calculated it from exhibit 17.6, where we got the 287,137. After all that, we will minus from the initial cost of the project in Canadian dollars. And the cost of the project in Canadian dollars, we calculated it from the currency exchange, which we knew it was 1.6 dollars is equivalent to 1 euro. So we did the 1.60 times the 5 million, which was the cost of the project. So to make it into Canadian dollars, we got the 8 million. So that's what we will deduct it from. And doing all our calculation, we got the 487,503. And we know if we have the annual present value as a negative or close to zero, we will want to consider the present value of the after-tax terminal cash flow. But because this is far from zero and it's also a positive number, which is not a negative, this will have a doubt that the European manufacturing facility will be able to profit a venture for the BlackBerry here. So that's it. When we are calculating our first scenario, which is what's the present value of the expected dividend stream in the Canadian, if the pound is expected to appreciate 3 pounds given, which is 1.1, and our work factor, which is 1.1, because we were given Beaver has a work of 11%, which will get the 1.1. So calculating our exchange rate, that's what for each and every single year, we'll have to use the work factor to calculate it as well, and with the exchange rate. And that's what we'll do for each and every single year. We'll use the work factor. When we are calculating our dividend growth, we have to keep in mind that we were told it's expected to increase by 10% annually, increasing by 10% annually. So that's why we have changes in each and every single year, keeping in mind it increases by 10% annually. When we want to calculate our dividend payment, we'll have to multiply the exchange rate times the dividend growth. That's how we'll get our dividend payment for each and every single year. So for every year, you'll have to multiply your exchange rate times the dividend growth. And when we are calculating our discount factor, we will have to use the work factor as well. And that's where we'll the numbers change because our T represents our years. So for each and every year, you'll have to put T with a respective year. And calculating our dividend payment, we'll have to do the dividend payment divided by the discount factor. That's how we get our dividend payment. So we add all the dividend payments up, and our answer that we'll get will be the 268,916. That's our answer for scenario 1. When we are doing our scenario 2, which asks us as what's the present value of the expected dividend stream if the pound is expected to depreciate 4% a year against the Canadian dollars. So we're using 4% depreciation. So here we'll use the pound appreciates by the 1.04, which is different from the scenario 1 because here we're using the 4%. Dividend appreciates by 1.1 will still remain the same. And our work factor, because our Beaver has a work of 11%, so this will still remain the same. So the same thing we did with the scenario 1 is the same thing we'll do with scenario 2 calculation. And calculating our exchange rate, we will have to use the 1.04 that we used. And calculating our dividend growth, this will still remain the same like from the scenario 1 and scenario 2 because we know it's expected to increase by 10% annually. So the 10% annual increase will still remain the same. And then our dividend payments, we will multiply the exchange rate times the dividend growth for each and every single year. For each year, you'll do the same. We multiply the exchange rate times the dividend growth. Then our discount factor will still remain the same like from the scenario 1 because it's still the same, and we'll use our the years because we still have the 4 years. And we also used the work factor of 1.1, which is still the same. And when calculating our dividend payment, we will do the dividend payment divided by the discount factor for each and every single year. So when we sum up all the answers for our dividend payment, our answer will get 298,034. So our answer for scenario 2 will be 298,034 for that. Thank you.
Okay, so in this case, in problem 2, we're exploring the possibilities of beaver expanding to Japan, as Japan is its fastest growing market, and the management believes that the Japanese buyers would typically prefer a homemade product over to an imported one. The beaver's management is considering now a possibility of building a new factory in Japan. The initial cost of investment would be 100 million yen, and the expected free cash flow from that investment would equal 10 million yen a year, with an expected growth rate of 10% for the next 3 years. Now, knowing that, as well as the exchange rate depreciation for the yen, we can calculate all the discounted cash flows for every year of the project life. And then, when we put it in our APV model formula, we can find out that the APV of the project is highly negative, meaning that the company shouldn't accept it because the construction costs of initial investments would be too high compared to the expected cash flow returns. Then, in this scenario 2, which you can see at the bottom of the page, we're exploring the same possibility under the assumption that there won't be any devaluation of the Japanese yen. And here, using pretty much the same straightforward order of the calculations, we still get the very negative sum at the end for our adjusted present value, meaning that even though it's a little bit lower than the APV of the first scenario, the management of the beaver should still not accept the project because it will only give the company significant losses and no profit. Be smart about your capital budgeting decisions, guys. It's the key. I guess. And that's it about the capital budgeting. I hope you guys enjoyed our presentation. And if you have any questions, feel free to send it to us via Moodle. Have a good day, everyone. Goodbye.